All right, split study number 2, 1090 versus 4060. Do you want to win the race or finish strong? If you've run track and field, cross country, or any type of race, you know you want to win the race. The finishing kick is not always going to win. Going back to that intro video, I'm always relying on my kick and I'm getting obliterated. So I finally learned I've got to get out of the gates faster. So with policy design, same thing. Here we go. We're going to look in this example, $100,000 per year, same company, same product that we looked at in the last video, all non-MEX, 1090 compared to a 4060. Here are the specific designs. Now, we didn't touch on compensation in the last video. I'm going to touch on it briefly here. In fact, let's look at the numbers. So here we've got our comparison sheet. Before we look at that, let's validate everything. Here's our 1090. If I'm you, I would want to know this. If I'm a consumer, having the knowledge I have on cash value life insurance, where's my money going? I can direct it toward the insurance premium, $10,000 base premium, which is as low as I can drive it with this company. This is with one of the major mutual companies, will generate approximately a $9,000 commission in the first year, and then years 2 through 10 with renewal commissions, $500 per year. That's how the compensation works. If we were to look at the 40-60 split, let's go to that. Here we go. $40,000 base premium. $40,000 base premium at 90%, what's that come out to? $36,000? $36,000. So, world of difference on compensation. $9,000 up front compared to $36,000 up front. There's also a 5% renewal on that, $40,000 per year as well. PUAs with this company pay 2% per year to the agent. So, compensation is in favor of what? Definitely the 40-60. But if you're a consumer and you say, hey, I don't care what the agent makes as long as I have the best possible policy for myself, which makes sense. Which one gives you more money in the beginning? Definitely the 1090. Going back to that, by year 5, you've paid in what? $100,000 per year for 5 years. Cash value, $502. You're breaking even. This is based on the non-guaranteed dividend rate. Death benefit, just about $3 million, which gives you a $100,000 MEC limit. Okay. The 40-60, at a 20-year fund, we do not need a term rider. If we wanted to fund 21 years with a 40-60 without a term rider at the same $100K per year, you'll run into a MEC. Based on the current dividend, midpoint guaranteed values, it will MEC. Options would be A, to add a term rider if we want to do a 40-60 for a longer period of time than just 20 years, or B, reduce the funding after 20 years. So what I attempted to do here was put the 40-60 split in the best possible position to succeed and actually produce greater value than the 1090 without triggering a MEC. When's our break even? $100,000 per year. It's easy to track here. Year 8, you've paid in $800,000. What do you have? $800,000. You gotta love these life insurance illustrations, right? What's your death benefit? Almost the same, $3 million. So let's do this. Look at the comparison sheet. What do we got here? 1090 on the left, 1090 split, 20 years. This is exactly the same. We peeled all the numbers. You can see it here, 502 in cash value. This guy, 800,000 in year 8, 800,000 in cash value. 800,000 paid into the policy. That's also what I have in cash value. Okay. Looks great. Now, let's have some fun. The question here is what? Which option is more efficient? And which option gives me more money? Would you rather have more efficiency, meaning you're seeing it grow by more and more each year, or would you rather have more money from start to finish to work with? I'd rather have more money. Like, if I compare myself to another business owner that has generated $100 million in revenue and he's got $100 million in his bank account, and I say, hey, we're finally catching him after so many years. He's still earning $100 million per year. Now, 30 years later, we're at 130 million, 150 million, like we're beating him year over year. But I've got 20 million in my bank account. He's got 150 million, like, hey, I'm not even close. And he's had more money all the way through. So I mention those big numbers because when working with people in corporations like that, that's how they view the approach. There's a reason why the wealthy, big banks, corporations take all of this capital up front. And they see it long term as well. There's a reason for that. So let's take a look here. What we're going to look at. Cash value growth. Let's compare this side by side first. What do you notice here? Year 1 and 2. What's your base premium on the $100,000, the 1090 split? $10,000. Year 1, 100K goes in. What does not show up in cash value? $12,000 and change. The 10K base premium, the cost of the term rider. There's a PUA rider charge as well with all policies, with most companies actually, not all of them. This example, 40-60 split, no term rider attached. 100,000 in, 64,000 in cash value. Almost $36,000 does not show up in cash value, meaning I pay in 100 and I see 64 show up. Year 2 with the 40-60, you pay in 100, grows from 64 and change to 132 and change. Cash value growth, negative 32,000. Same thing year 3, 7,800, negative. It's by year 4, I finally start to see more money come back than what I pay in. That's the net cash value growth, excluding our payment. That I don't count as growth because it's money we have, we're paying into the policy. If I look by year 20, similar to the last video, with the 15,000 per year going in, what do you notice here? The 1090, you grew by 120 grand, and with the 40-60, you grew by what? $130,000. Wow. You're growing by $10,000 more with the 40-60 than you are with the 1090. Sometimes we hear, well, that's the most important piece because you're more efficient when you look at the growth. I'm like, no, I've got more money here and I had it from start to finish, which is a huge opportunity cost. It's like when you look at this, like, what am I missing? I take more money from start to finish and then I can invest that in myself and continue to push forward. Now, what I am missing, which this is not how I think, by the way, but on the compensation, this is reduced on this guy. So I want to look at the net cash value from start to finish. You can look at the net death benefit as well. This generates greater death benefit long term. It's interesting how it works, isn't it? Let's look at the cash value difference between the two. So time passes. What do we notice? 20 years. What do you have more money with? Simple as that. If cash value is your goal, so what are the core benefits to a cash value life insurance policy? Safe, liquid, tax-free. In the first video of the split series, we mentioned how and why the ultra-wealthy banks, corporations use this, how the wealthy know what to look for because they have advisors that know what to look for, like an Elizabeth, like a Scott Witt, that are not in the industry, but they have training on the product and serve as that disinterested third-party advisor. That's why I like those people so much, which, by the way, we have zero financial incentive with them. We align in so many ways. That's why I recommend them. Cash value difference. $60,000 more by year 20, and you had more money all the way through. I mentioned this in the first video. Spoke with a couple that they will do close to $100 million in revenue this year. That couple was presented whole life insurance, high cash value life insurance, first with options that took 7 to 10 years to break even, not enough money up front. And they saw the long-term benefit. They did not move forward with it. The simple reason, the husband, this sticks with me, he mentioned, it's the opportunity cost. Like they keep telling me, no, you're not understanding. It's the long-term value. He's like, listen, I built my business with capital up front. That's what I invested in my business. I kept on growing it. So when you're telling me to sacrifice that for a little bit more long-term, which by the way, doesn't even happen, He's like, no, it doesn't make sense. Core benefits, like why he was attracted to a cash value life insurance product, had a lot of money in cash, already had money in other areas, saying, okay, here's money in cash, can put it into a high cash value life insurance policy, safe, liquid, tax-free. If everything tanks in the market and economy, this will continue to produce that 3 to 5%, no risk. The tax-free benefit is huge at that level, but that's how everyone approaches it. You don't have to have millions of dollars either in order to make this work. I use them as an example because that's someone who has it figured out, that couple. So obviously we want to learn from them, copy them. How do they get there from a business standpoint? But then also, what are they doing with their money? And then what are the details they're doing with these policies that their advisors know what to look for? Like, that's the kind of stuff that's very valuable to me, that I take away anytime I'm learning about something that I don't understand, other than cash value life insurance. So as we look at this over time, what do we notice? Cash value difference is in purple. Do you ever have more money in the 40-60? No, you don't. For a point in time, it was growing at a faster rate, but eventually it slows down again because we stopped the funding after 20 years. If we try to do the same thing, funding it for 50 years, the outcome's the same. And again, we took that 40-60 with no term rider. Well, in the 50-year fund, we had to add a term rider in order to fund it at that level that long. Same thing with a 1090, but there's no difference there. And again, we're not saying a 40-60 is just evil and never go with it. That's not the intent at all. Like this policy, this 40-60 split, where it would work, I mean, if he's got a 40K base premium, which he does, is we would tweak the death benefit in the policy a bit more and set it at a 400K MEC limit, and he could, in a sense, continue to fund a 40-60 split, but now he has the ability, based on the insurance company limits and the IRS limits, to add up to $400,000 per year here. So he's got more window room that he can plow into the policy. Like, that's the big thing there. How do I equip the policy to have more space so I can add into it if I want to, but not be committed to it in the event things do not go at the pace or rate I anticipate, if that makes sense. So hope you enjoyed this video with the spreadsheets and such. If you have any questions, please feel free to reach out anytime. If you enjoyed it, please click the like button, hit subscribe, and I hope this helps. Talk to you in the next video. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.